of Tax Foundation University. Today I'm going to be going over basically tax reform and how it's going to interact with some of the budget rules and why that poses some challenges in how you're going to put together, how lawmakers are going to put together a tax reform proposal. So what that means for revenues, what it means for offsets and potential to have to change transition with your tax proposal. So the big topics that I'm going over here, first, just a quick overview of budget reconciliation, which I think is probably the most important piece that's going to interact with tax reform going forward. Then how those rules are going to interact with tax reform, meaning how you're going to have to craft your tax bill to conform with them, and also looking a little bit at the House GOP blueprint, which is the main proposal out there, and how they put it together and how they may have had the reconciliation rules in mind when they did so. Then I'm also going to touch upon one, alternative revenue sources or spending offsets, or means of coping with the budget issues. So you can imagine that the rules put in place have some constraints on how much revenue you can lose up front, how much revenue you can lose in the long run, and what you'd need to do in tax reform to sort of offset those things to make it work. And then transition issues. This pertains mostly to the blueprint in how revenues are affected over time. When you change tax policy, it doesn't always have an equal impact on revenues every single year. Some proposals you put forth have a huge impact up front and a much smaller one in the later years, and vice versa. Some have a very small impact up front and a big impact later, and depending on the size of your budget window, those costs or benefits may not be fully accounted for when you look at, say, a JCT score that looks at a 10-year window. And then the last issue I'll go over is some of the, just capping this off, or what are some of the unknowns of tax reform right now. You know, honestly, tax reform is still kind of in its infancy if you look at it from the outside. You have some very basic proposals out there that are good outlines, a good starting point, but some of these issues pertaining to specifically the budget rules haven't been decided yet, and even proposals themselves, so what's going to be in the tax reform, hasn't even been decided. So I'll be going over some of those questions at the very end. All right, diving into the budget rules, or at least the one that matters here, and that's that's budget reconciliation. So just very basically, I'm not a huge budget expert, but this reconciliation is it's a legislative process that allows lawmakers to make changes basically to spending and revenue levels. It needs to be part of a budget resolution. And of course, this drives a lot of the discussion over the past year about the timing of certain legislative objectives, especially from the GOP. They basically have two budget resolutions that they can work with, the 17 and 18, and that's where they're going to be playing with the reconciliation. The first one being healthcare, and that one is maybe almost done with, but still a little bit of debate to go. And then you have the 18 one where tax reform is supposed to be taken care of, and that's going to be the second reconciliation package. In reconciliation, technically, you can increase and decrease budget deficits over the budget resolutions window. There are, of course, Senate rules that may limit this, the pay-go rules, for example. But if your budget resolution says that we want revenue levels to be X dollar lower over the budget window, that's what your reconciliation package can say. And the window itself doesn't necessarily need to be any specific length as long as it's 5 years. So the law set out when this was put in place that it's at least 5 years. Right now, the typical is 10 years, but there's nothing saying that it doesn't have to be back to 5 years or 15 or 20 years. And this is actually an important point because this has been brought up as a way to in a sense, pay for tax reform, or at least make tax cuts or whatever they put forth work, at least on a semi-permanent basis. Budget reconciliation avoids the filibuster. This means that it can be passed with just a simple majority rather than the 3/5 majority. That speeds increases the speed at which this can be passed through, but also avoids having to make the proposal bipartisan, at least in the current makeup of Congress. Lawmakers could conceivably do tax reform or anything in a bipartisan manner, but I think realistically it's probably not going to happen. That's why reconciliation is so important in the current debate. And the last piece is, and this goes on to my next chart, is reconciliation. It's subject to a number of restrictions, and these restrictions, I think, play an important role in how tax reform needs to be structured. So the first and big one is the Byrd Rule. So unless overturned with 60 votes, of course that means if you had 60 votes to overturn the Byrd Rule, at least in the context of tax reform for the Republicans, you wouldn't need to use reconciliation in the first place. But unless it's overruled, the reconciliation bill cannot increase deficits outside the budget window. And if your budget window is a 10-year window, that means in the 11th year you can't increase your budget deficits. So this puts a restriction on tax reform, of course. So any tax cuts, say you want to cut the corporate income tax, that needs to be offset somehow, whether it's through increases in taxes elsewhere, or, as I'll get into this, you could actually offset it by simply making the tax cut go away. And this has been done in the past. Senate pay-go rules still apply, again, unless waived. Pay-go rules mean that any increases in deficits in 1 year need to be offset again. So this actually may have an impact on the structure of the tax reform within the budget window. And only one reconciliation bill per budget resolution. So this plays into why it's such a hurry to get tax reform put together, because you are constructing it for that 18 budget resolution that the Republicans have in order to pass tax reform. In the last point that I don't have up here, and this plays into a point that I'll make later about offsetting tax cuts with spending, is that reconciliation can be used to change spending levels, so it doesn't have to be strictly a tax bill, but there is restrictions on the type of spending. Specifically, you can't muck around with Social Security. So you can change mandatory programs, but just not Social Security. All right, getting into how this interacts with tax reform. I think the three big issues that I'll go over here. One is structuring your tax reform to be revenue or budget neutral versus a tax cut, meaning a reduction in tax revenue. I mean, it could be a tax cut with spending reductions, and that would be technically a tax cut. Second, will your proposal be temporary or permanent? In the past, I think the best known example of using reconciliation for taxes was the Bush tax cuts in 2001, 2003. And that's why we have this idea that reconciliation is used for temporary tax policy. Well, not necessarily. If your proposal is structured in a way not to increase budget deficits in the out year, it doesn't necessarily need to be a permanent or a temporary change to legislation. Then the last piece is I'll talk a little bit about the use of dynamic scoring and how this interacts. That dynamic scoring is an improvement over the scoring methods we've been using in the past, but it's not something that can be just used to wave away all problems. But it is something to consider in this issue. So the first issue here is going into a tax proposal that is revenue or budget neutral. So in order not to be burnable or struck down because it increases budget deficits in the long run, tax reform will need to be revenue or budget neutral outside the budget window. Now, this doesn't necessarily mean that it needs to be revenue neutral within the budget window, and I'll go into this, especially with the House GOP proposal. The GOP proposal, at least in the budget window, is a substantial tax cut, but it's actually a much smaller tax cut once you peer into the 11th year and beyond. So your tax reform, if you're looking to cut marginal tax rates for individuals and corporations, which is a typical goal for Republican tax reform proposals, well, in order to comply with the Byrd Rule and make your policy permanent, well, you're going to need to offset that. And if you look at the House GOP proposal as your example, there's a number of base broadeners in there that they use to offset the substantial tax cuts that are built in there. They have the state and local tax deduction, which would be eliminated, which is a substantial base broadener on the individual side. There's the elimination of the deduction for net interest expense on the business side, and there's also the border adjustment. These three things, I think, account for the vast majority of the revenue raisers or the offsets to the tax cuts that are in that proposal. The Trump proposal, it's hard to say exactly what's going on there yet, but they did at least name one major base broadener, which is the state and local tax deduction, as their offset. So at least they're thinking, again, in terms of this may need to be done through budget or the reconciliation process, and that the tax cuts that they're aiming for need to be offset somehow. And if they're going to look at just the tax side, they do need to make base broadeners. As I said in a previous comment, these tax cuts could be offset with spending reductions as well, but there are trade-offs there. So say your tax reform cuts taxes, everyone likes that, but individuals may not like the base broadeners that go along with your tax reform, your tax cuts. So in order to get around that, well, we won't raise your taxes elsewhere, instead we're going to cut spending. But of course, you then inject spending reform into your tax debate. Now here, just to further this point, especially on the House GOP blueprint, is we're going to look at just the revenue impact of the House GOP blueprint over time and what it may mean for the reconciliation. So when multiple groups have estimated the GOP blueprint, they found that over the 10 years that the blueprint would impact, over the 10-year window, that the GOP blueprint would reduce revenue by about $2.5 trillion. So on average, that's about $250 billion each year. If you were to just look at that 10-year figure, but that's not actually how the revenue impact of this plan works. In fact, what happens with the GOP blueprint is that in the first few years, the revenue impact of the blueprint is substantial. In fact, the first year, if you were to do it in nominal terms, reduces revenue by about $360 billion, but that number declines over time. You can see here, this chart, what we're looking at is the revenue impact as a percent of GDP going into the future. And while in the first year, you're reducing revenue by 1.8% of GDP, by the time you get to the end of the second decade, you're reducing revenue by about 0.2% of GDP. And this is on a static basis. We're not looking at dynamic scoring. We could talk about that, but that dynamic scoring would be an additional offset to this. But what we're looking at here is just the static cost directly to the government without any changes to the economy. Now, reconciliation-wise, if you are not concerned about your first 10 years, what you're concerned about is the last 10 years, well, you'd be concerned about 2027 and forward. That is what you would need to offset in order to make this permanent if the Byrd Rule is what you are mainly focused on. So that what this means, of course, is that the GOP blueprint, if passed as is, the offsets that would need to come would be the ones that happen in the last decades, the second decade. So you don't necessarily need to offset the full $2.5 trillion tax cut. You need to think in the future, and the offsets are actually relatively small compared to what traditional analysis is showing you. And the reason, and I think Steve probably went over this in the past, is the reason there's huge upfront costs that taper off is mainly because there's a transition to a cash flow tax. That one, you're enacting expensing of capital investments, and two, you are eliminating the net interest expense deduction. Expensing has a big upfront cost as old investments are being written off and new ones are being fully written off the first year, so you're kind of double counting in the first few years. And then on the interest deduction side, you are only accounting for new loans in your proposal. Old loans you continue to deduct as a business. New loans, you no longer get that deduction. So both of these work in a way that make the upfront costs really high and the costs in the future are much smaller. So one way, like I said, one way to offset your revenue losses isn't necessarily to make the tax, to add base broadeners to your proposal. Well, you could make it temporary. And set the plan to expire so it's not impacting revenue outside of the budget window. Now, like I said, the big example of this are the Bush tax cuts of 2001 and 2003. These were set to expire in order to make them comply to the Byrd rule. Now, related to the GOP plan, the fourth bullet point here, if the plan slightly increases deficits in the out year, it's not necessary to make the entire plan expire. So you could think about those last, going back, these last 10 years, you could make parts of the plan expire. So you could add a partial temporary aspect to the tax reform proposal, and that would offset what's going on in the out years. So it's not necessarily the case that the entire piece of legislation needs to expire. It's just enough would need to expire to comply, but it would still be, in a way, a temporary proposal because the entire thing isn't lasting. Now, a caution here is that the length of the tax cut is not necessarily the same as the length of the revenue impact. So in the Bush tax cuts, we think of those as, well, that was a 10-year tax cut and it expired after 10 years, but that's actually not really the case. The Bush tax cuts, I think, they were actually only on the books for 9 years and a few months. And the reason for that is because when you change taxes, or this is at least how it's modeled by the Joint Committee on Taxation, is when you change taxes, this has behavioral impacts for individuals. People shift their income over time. So if you cut taxes 1 year, individuals may shift their income from later years to earlier years. And while that you may have only a tax cut the first year, your second year you may be losing revenue as well. And that behavioral effect can make your plan violate the Byrd rule. And this is especially important if you're looking at corporate taxes, because corporations have immense flexibility in the timing of their income and their deductions. So if you were to cut corporate taxes on a temporary basis, corporations are going to be able to make long-term plans to determine what's the best way over time to allocate my income, allocate my expenses, allocate my credits to reduce my tax liability. So if you imagine a proposal that's simply, we're going to cut the corporate tax to 15% and then make that expire. Let's say it's a 10-year tax cut, and then after that 10th year, it goes right back up to 35%. Well, if you're a corporation, you're going to say, well, in the first 10 years, my tax bill is going to be really, really low, so I'm going to want to load my profits up in the first 10 years. But in that 11th year, that's when my tax bill could conceivably go up significantly. So what I'm going to do is I'm going to shift my deductions into the future so I can reduce my tax liability going forward. The effect, from the government's perspective, is that the tax cut is going to reduce revenue in the first 10 years, but maybe by not as much as a static analysis would indicate. You would have that initial cut in revenue, but behavior would shift that income into the first 10 years. You wouldn't lose as much, but what you gain in the first 10 years is what you lose in your second and third 10 years. So you actually may have a negative revenue impact going forward far after your tax cut expires. So if you would want to make a corporate tax cut temporary and comply with the Byrd rule, especially within the 10-year budget window, your tax cut would need to be pretty short in order to make sure that corporate behavior isn't impacting revenues outside the 10-year period. So that's just a caution here, is that the length of the tax cut and the length of the revenue impact are two different things, and that if your proposal is simply just a tax cut, you may still need to find offsets that happen outside the budget window, even if you were presumably just doing a tax cut proposal. Now, another question is related to this, is that what about a longer budget window? And this is one way that you could make your proposal last longer. But it's going to depend on what type of tax cut that you put forth and your budget window length as to how long your tax cut can be. Going back to the corporate example, it's possible that if you extend the budget window, say, to 30 years, this may only get you, say, a 6 or 7 year corporate tax cut, because the behavioral impact may be so strong for companies, especially with the offshore earnings and being able to time those, that you may not get very much, even if your budget window is 30 years. On the individual side, you may be able to get a lot, because individuals don't have the flexibility to time their income as much outside of capital gains, where you can just decide when to pay taxes. But as a wage earner, I can't decide when the tax foundation can pay me. I can't say, wait, could you pay me a lot of money up front because taxes are going to be much higher in the future? I don't think that Scott Hodge will go for that. One of the big downsides of temporary tax policies, you have to think of also its interaction on the economy. And if your goal in tax reform is to grow the economy on a long-term basis, President Trump seems to be, then you have to think about, if it's a temporary tax, is that going to get you the economic impact that you're looking for? This chart here just spells one of the trade-offs here, is that temporary tax policy may get around the issues of having to fully offset your tax cuts, but the downside here is you're not going to get the same economic growth as you would expect from a permanent tax reform. Now, what this chart is looking at is real GDP growth from 2017 to 2026. It's looking at three different scenarios. Scenario one, which is the bottom line, the blue line, that is the baseline. That's if nothing changed and what CBO says is going to happen happens, and we still have our 35% corporate tax. Scenario number two is the top line. If you were to enact a permanent 15% corporate tax rate, what GDP growth would look like then on an annual basis. And then the third scenario is the middle line, or at least it starts as the middle line, but then declines to the bottom line, is if you enact a 15% corporate rate on a temporary basis or a 10-year basis. So what's happening here is you see that in the first few years of enacting a temporary corporate tax cut, you get additional economic growth. Companies see that, if I make an investment in the next couple years, I know that my profits, at least say for 5 years, are going to face a lower tax rate, so I'm going to be willing to invest. However, that incentive starts to turn a little bit once you get to the later years. You have two things happening here. Issue number one is companies no longer see that their investment is going to face that lower tax rate the entire time. So they may say, all right, well, this investment's supposed to last for 8 years, but I'm only going to get a tax cut for 5 more years. It's not going to be worth it to me. Then there's a second issue, is that in a way, some of this temporary policy increases taxes on certain types of investments. So if you were a company that decided to, for whatever reason, look at an investment in 2025, the year right before the tax cut were to expire, you would analyze this, showing that you would be able to make your investment that last year, get a deduction for that investment, but that deduction would be against a 15% corporate tax rate. But then the next year when the corporate tax expires, you're going to instead be getting you've already gotten your deduction up front for your investment at the 15% rate, but now you're being taxed on your profits at a 35% rate as the corporate tax expires. That's actually an increase in a potential increase in the tax burden on that investment over and above current policy. So that may actually be a higher tax burden than what you would face if the corporate tax just remained at 35%. Because if it was 35% consistently, you would at least get a deduction against your 35% tax up front. But you're actually losing the ability to get that 35% deduction because it's actually now a 15% rate. So you get some of these odd interactions with temporary policy that you need to look out for. And you may, if you look at economic growth, see a smaller amount of growth on an annual basis in the out years as companies realize that, oh, this isn't great to invest because the corporate tax is about to go back up to 35%. Now, the last issue here is looking at dynamic scoring, and I'm quite certain that Steve went over this in great detail over the last couple weeks. But this dynamic scoring is going to be it incorporates economic impacts into your revenue forecasts. So if you have a tax proposal that grows the economy, that's going to broaden your tax base, and it's going to, in a way, if you look at it budgetary terms, be an offset to your tax cut in a way. And this could be especially true if you're looking at your tax cut on a longer term basis, that some of these things take time to pick up. Say you increase investment incentives, it may take a while for investment to pick up. The base needs to broaden over a couple of years, so you may see in the later years more revenue because of dynamic scoring. Now this could help in a couple ways, or it interacts in a couple ways. So the first one is if you were to use dynamic scoring and also account for a longer budget window, and I'll get into JCT's model a little bit, but and also assuming that you somewhat offset your tax cut, the longer you stretch out your budget window, it's perhaps the more dynamic revenue you may be able to get, simply because the Joint Committee's model takes seriously sort of if you were to reduce debt, that improves the economy and it builds over time, so you may be able to get additional revenue there. But also it could help just in general with tax reform, because either in the first 10 years. So two cautions about this, especially dealing with reconciliation. One, it's not going to be able to completely offset any tax cut. And this is especially true using Joint Committees models. So if you are going the path of reconciliation, highly likely for lawmakers at this point, and you want tax cuts, you can't count entirely on dynamic scoring to make your tax proposal permanent to pass the Byrd rule. So the Joint Committee on Taxation, what it's going to see is, well, you've increased the budget deficit, and so while your tax cut does improve investment incentives, it also is going to increase the deficit and crowd out. Now, I don't necessarily think that that's the correct mode of analysis, but it's a reality that I think that that lawmakers need to deal with. So it's going to be necessary, even in a world of dynamic scoring, to look at offsets to your tax cuts, even if it means that perhaps you don't need to fully 100% offset it, but it's still, you need to get to a point where your tax cut isn't just a significant one that increases the budget deficit. And the last point, just to repeat myself a little bit, is the Joint Committee on Taxation's model. One thing that it takes seriously, or it's uses to great effect in its analysis, is the impact of deficits on the economy. Now, the Joint Committee on Taxation's model assumes that when the budget deficit increases, this is going to crowd out additional private sector investment, and this is going to actually shrink the economy. So in their model, it's conceivable that if you cut the corporate tax, even though we know that that's going to at least somewhat increase the incentives to invest, expanding the economy, the Joint Committee is going to say, well, that may be true, but you're also increasing the budget deficit, and the government borrowing is going to take away from the corporations even more than what you're giving in terms of a tax cut, and you actually may see the economy worsen with a straight corporate tax cut, meaning that your dynamic score is going to be slightly worse than your static score, interestingly. Now, there are reasons to doubt this, at least looking at recent experience in the economy. We've seen a huge increase in budget deficits, but not necessarily big increases in interest rates, which would indicate some sort of crowd out in the economy. So it's not clear that this is something that actually happens. But it is, like I said, it is something that the Joint Committee is going to point to and say, you're going to need to do some sort of offsets, or you're going to end up shrinking the economy. And one place that you can get a preview of this in a way, if the Tax Policy Center, they have a pretty detailed model, and they've recently introduced dynamic scoring into their analysis. They have two models. Both of them are actually similar to models that the Joint Committee has used in the past, and those models heavily incorporate this issue of crowd out. And what they find with the analysis, which is consistent with how you would think about this, is that, well, you've made these big tax cuts, they've improved incentives, so you see a slight amount of economic growth in the first 10 years, but you haven't fully offset your tax cuts. So the debt is starting to build, and that's crowding out private sector investment. And by the second decade and going forward, you actually see a negative dynamic score driven by the fact that investment is now lower than it otherwise would have been in those models. I'm sure Steve has gone over this. Our model does not think that this is a major driver in the economy. We think that foreign savers are more willing to provide money to both the federal government for borrowing, but also to private sector investment. So you wouldn't see this spike in interest rates and this crowd out of private sector investment. And of course, this is a double-edged sword in terms of policy. I mean, if you looked yesterday at the president's budget, the CBO said that his budget, not looking at any tax reform, would grow the economy slightly, first by about 0.1% annually over the first decade, accumulating to about a GDP that's about 0.7% larger than it otherwise would have been going forward. And the reason for that is because the president's budget was able to reduce the budget deficit. So the CBO is accounting just for that that part of the budget. No incentive changes due to tax policy, just the fact that he was able to reduce spending. Now, honestly, I think that's probably, just looking at that piece, a slightly optimistic look at the president's budget, because what's probably going to happen if the president were to enact this and reduce the deficit through spending is that additional that additional capital that's freed up from the government not borrowing as much, it's probably just going to go right back to the foreigners where it came from, not really providing any additional economic growth to the United States. So it is that mode of analysis that JCT and CBO use is a double-edged sword in terms of budget making, that you may be able to get something additional on the tax side because you're not getting that crowd out, but on the spending side, you're not going to be getting as much as what CBO would otherwise tell you. Now, just to wrap up here, just to throw out a few remaining issues in tax reform, and just to leave it as like, what do we know so far? What do we think is going to happen? Just overall, in my view, tax reform, at least right now, is kind of in its infancy. We don't have a legislative proposal yet. We can't really bicker about the very small details that go into, say, the border adjustment or the phase-ins and phase-outs of different rates. We're still operating in a world where we have two proposals at best, one which is 12 bullet points and the other which is a 36-page primer. So there's still a lot to do there. Now, the first point here is that one issue remaining in tax reform is how it's going to interact with the health care bill. Now, the health care bill has some tax policies built in there. The two big ones that may interact with tax reform are, one, the net investment income tax, which is that 3.8% tax on passive income over $200,000, and also the additional Medicare tax, which is 0.9% payroll tax. Those two, well, if they're dropped from a health care bill, and Republicans really, really want to get rid of them as part of their agenda, well, it's possible that they are added or tacked onto the tax reform proposal in the second reconciliation bill. Well, if reconciliation requires that tax cuts be offset somewhere, whether it's spending or additional base broadeners, well, your base broadeners now need to be about $350 billion larger. So that's an important question that needs to be resolved there. So does that mean that tax reform is a little less bold in terms of what you do on the cut side? Or do lawmakers look for additional base broadeners over and above the ones that are already on the table, such as eliminating interest or eliminating the border adjustment or adding the border adjustment or what have you? And the second point here is, if there's a lot of political back and forth already about some major base broadeners in the proposal. Well, that's an issue if you need to pay for your rate cuts. So if lawmakers were to jettison significant base broadeners in the tax reform proposal, what's the alternative? What's going to happen, and what's going to take their place? For example, the border adjustment, that's about a $1.3 trillion base broadener, at least in the first 2 decades. If you want to get the rates down to where they are in the House GOP blueprint, you'll have to find an additional $1.3 trillion. Now, there are some base broadeners out there that accomplish that. For example, you may eliminate the cap on the payroll tax, but those have different implications. Those fall on different taxpayers. They interact with legislation in different ways. Reconciliation really can't mess with Social Security, so you may have to do something additional if you're going to be increasing the payroll tax. And other issues such as the state and local tax deduction, this one seemed like a slam dunk for the GOP because, but there's already a little bit of pushback there because people realize, well, well, I represent a state that really benefits from this, even though it's part of this tax reform proposal that I really like. So that's an issue that needs to be resolved. And going back to the border adjustment really quickly, if the border adjustment is replaced, you also, or lawmakers also need to deal with the fact that base erosion is a concern, especially if you're eliminating the additional tax on foreign profits for U.S. multinationals. That is something that has been discussed in the past. It's also been highly controversial in the past. So that's something that would need to be brought up and resolved rather quickly if something like the border adjustment goes away. And then another piece is that you may, in a way, be able to find arithmetically all sorts of ways to offset your tax cuts, but they may have different implications on which taxpayers they impact. Maybe instead of going for base broadeners, you go for spending reductions. Well, spending reductions also have distributional impacts that lawmakers need to be aware of, and the politics of that is probably proven to be a little tricky. Looking at just the ACA repeal and replace, that reconciliation package was marketed, or the narrative around that was a tax cut paid for by reductions in benefits for individuals, and that didn't go over very well. I mean, they backed off of the significant tax cuts there because of that narrative. And if spending cuts are introduced to a tax reform proposal, it's possible that that narrative happens again. So lots of different trade-offs if you were to start picking and choosing different base broadeners. Bottom line with that one, of course, is that all of this is probably going to be pretty tricky no matter what path you want to take in tax reform, whether it's going with the border adjustment or something else. Someone may end up yelling at you. At the end of the day, lawmakers probably just need to pick whichever policy they think is best in order to get it done. So another small point here is one issue with some of these proposals, like I said, is they come with very large upfront costs. And if lawmakers look at a score and say, wow, in the first couple of years, the budget deficit is going to spike by $380 billion and it would be in excess of $1 trillion in total. That's a bit tricky, so politically to sell. So perhaps there may be reasons to offset the significant costs in the budget window, and there may be lawmakers may need to look at proposals to offset those. There are ways to do that. Tax cuts could be phased in over time to reduce their costs up front. But back to the theme of tax reform is kind of in its infancy. There hasn't even been discussion of that because no legislative language yet that talks about that. I think just generally, just wrapping up here, and Steve may have some general comments here, is that there are, like I said, there are lots of things that need to be determined in tax reform, especially on the administration side. So, I mean, it's early in the game, so a lot of these political fights will continue, and I think reform, it's worthwhile. Most economists are going to tell you that reforming the tax code is a good thing, but no one said it was going to be very, very simple. Now, I don't know if Steve has any closing comments for Tax Foundation University in general, but Steve also said there are there's a reading list for you for additional topics that cover all sorts of policies. So I'll hand it off to Steve. Thanks.
Don't go away. You've got the microphone on your lapel. I just want to thank you all for coming. There is the reading list over there. The reading list will also go up onto the website, so you don't have to start typing in all those long links. We have, but you know where to reach us. Kyle and others have been doing a lot of modeling work for members on the Hill who have questions about how much this or that might cost, and I'm only too happy to volunteer Kyle's time to do more of that. But no, seriously, if you have questions, please do feel free to call us, and thank you for coming.
Thank you.
Thanks.